people confuse investing and complexity. They assume that if you're a sophisticated investor, you're going to have a complex portfolio. Whereas the truth is, for most people, 2 or 3 funds will get you to where you need to be.
Okay.
For my portfolio, my core portfolio, I've got 1 fund.
Oh.
The truth is, it's not that hard. It really is easy to do it. As long as you keep it simple, and you can probably match a lot of the professional portfolios that are out there, if not beat them. Biggest risk is you. The other risk is you don't invest enough. The market will not make you rich unless you invest.
Yeah.
So I think that's why people don't usually succeed at it, because they just don't stick with it. You've got to have faith that it's going to go up. And that's hard. It's very difficult. But in 10 years' time, you will be so glad. Imagine you had a telephone and you could speak to yourself 30 years in the future. What would that person be telling you? They'd be telling you, put as much as you can into the stock market.
This strategy, right, of investing in a low-cost global ETF or index fund, that's been a proven strategy for people to build wealth. Do you think that will still be this go-to strategy for building wealth in the near future?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people. Like
you have to be able to be uncomfortable. Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode. I'm your host, Atto. We have a special guest in the building. We have Ramin, who's the founder of Pensioncraft, where they teach and provide you the skills to invest in the stock market. They provide friendly, unbiased, data-driven information and education to help guide you through investing. He also worked in investment banking from 2001 to 2016, where he spent 12 years of the 15 as a strategist for a Swiss investment bank. He's the author of 2 finance and investment books, a financial bestiary written for fund managers and investment bank employees in mind. And his second book, Invest in Fear, explains how to buy and sell volatility using exchange traded products. Ramin, how are you doing today?
Very good. Thank you for having me.
Welcome. I'm looking forward to this conversation. I mean, you're a legend in the investing space, especially on YouTube. So I think this is going to be a very great conversation, especially as more people are getting into investing in the last 4 years. I think it's very important to help guide, especially the new investors. So, obviously I described a little bit about you. Who would you say Ramin is?
I think I'm helpful. I think I'd like to keep things simple. I like to explain things to people in a simple way. But really, I think I'm really trying to teach people what I know, because I learned a lot while I was in banking, and I really wanted to give that back to the community so that people know what people's incentives are and how they can get a good outcome when they invest. So that's really what I'm trying to do.
Yeah. And it's interesting when you talk about the incentives, because we're going to talk a bit about that, because I think a lot of people, when it comes to investing, they don't know the behind the scenes of how it actually works. And I think it can be a bit confusing at times as well. So how has your life experiences and upbringing shaped you into the person you are today?
Oh, that's interesting. Well, my father was a businessman, so he was really into business. He studied economics in America. He was really into profit. He wasn't very ethical, put it that way.
Okay.
But he did everything. He was an amazing salesman. He was very good at selling stuff. I'm a terrible salesman, right? So whenever you see my videos on YouTube, you'll see, I have to ask people to join our community. I kind of push our products, but yeah, I'm just really bad at it.
Is it that you cringe at doing it, right? Yeah, it's part of the game. I cringe at doing it as well. I was like, I don't really want to do this, but I have to if you want me to continue doing this for you, right? Yeah.
But I mean, when I was growing up, I was really into maths and physics, and I did a degree in physics, a doctorate in physics. So, that kind of numerical background, I think, has shaped me. So whenever I talk about stuff, it's in terms of graphs, numbers, and I always try and ground it in truth. Whereas a lot of people on YouTube, it's about emotion and trying to say that things are about to crash, or doom porn, as many people call it. And that gets lots of clicks. But that's not what we do. We try to make it factual, simple, and just say it how it is.
Yeah. Yeah. And that's important, especially in the stock market when there's like so much going on. There's so much emotions. There's so much FOMO, fear. Yeah, there's definitely a lot going on. And I think as a beginner investor, even like I would say even for existing investors, sometimes you have to recalibrate and just be a bit careful because there's so much happening. Like right now, we've got the whole thing that's happening with Bitcoin, the stock market is doing well, and I think sometimes that can make you think, ooh, should I jump in here? And then you're like, oh no, actually you just try and recalibrate. It can kind of play tricks on you, right? So you worked at a Swiss investment bank, right, as a strategist where you helped like several clients. So you mentioned to me pension funds, sovereign funds as well, right? I guess what were the activities that you were helping your clients with?
Well, we publish research. So you write a research note and then it gets published to all of these money managers and hopefully it'll help them allocate more effectively. And what we were doing was asset allocation. So it's not about which stocks you buy or which bonds you buy. It's how much bonds, how much stocks, which country to put the money into. Do you buy gold? Do you buy oil? What's going to perform best given this macroeconomic environment? So it's like a kind of top-down process where we took input from the economics group, from the bank. We also got input from the strategists in each different area, credit, precious metals, equity, and we kind of were the kind of central point where all of that information came together. So if the economist said that the price of oil was going up, we'd say, well, these countries are not good. India imports a lot of oil, UK imports a lot of oil, so that's going to be a cost. And then we'd figure out what to buy as a result of the macroeconomic picture.
Okay.
That's pretty much what we did.
Yeah. Wow, that's so interesting. I guess you must have seen a lot during that time, right?
It was amazing because, I started off and it was just at the tail end of the financial crisis. So I saw all the damage which that did. And, at the bank, you'd be walking around and entire desks would disappear where they literally fired the entire team.
Wow.
Because, that asset class basically imploded. So it was pretty shocking, the changes we went through. But it was interesting, being the strategist because there was so much going on. I learned so much. And of course, you get to talk to the clients. So part of the work was writing research notes. Then you go and market it. So you go out with the salespeople to, various countries. You fly out, you talk to the clients and you show them your, slide deck. And you talk them through your ideas. Some like it, some don't.
Yeah.
And literally you go from client to client to client to client, and you get as much information back from the clients as you give them. So we learned so much from the clients.
You were like, it's like two-way information.
We were kind of like an information bee. You'd visit every single flower, but then you pick up the pollen from each flower, and we learned a lot from the clients.
Wow, that's so interesting.
But it was interesting meeting the people who actually manage your money because they're very dedicated, good people, but they fail to do their job a lot of the time, which we never even discussed.
Yeah, that's so interesting. Okay. One of the things I no longer worry about when it comes to traveling abroad, especially when I'm on holiday, is paying huge roaming charges. As a savvy traveler, I was able to stay connected to the internet without breaking a bank and easily explore new places with the convenience of an affordable eSIM. So when I travel to Japan, instead of paying for an expensive data add-on or spending time looking for a local SIM card, I use Yesim, a leading eSIM provider that offers budget-friendly and reliable internet plans in more than 200 countries worldwide, including Turkey, United States, UAE, Thailand, Spain, and more. Honestly, I was amazed at how fast, simple, and convenient it was to set up my eSIM. It only took a few steps. After logging into the eSIM app, I selected a country and mobile data plan, confirmed my choice, and then installed the eSIM to my phone. Moments later, I was connected to the internet, which had great coverage and fast internet speeds. By selecting the unlimited data package, I enjoyed uninterrupted connectivity throughout my trip, allowing me to fully explore Japan with no limits. So if you're interested in getting an affordable and reliable eSIM, I've partnered with Yesim, who are giving my community a special offer where you can get a €5 discount on any packages by using my promo code SAVVY5. The discount will be applied immediately on all plans. You can purchase a data package now and activate it anytime within a year. If you're curious about trying out Yesim, they are offering a data plan to new users which comes with 500 megs of data and is available in 48 countries for a very small cost of €0.50. It's a completely risk-free way to try out Yesim. I've left a link in the description below, so check it out, give it a try, and enjoy great connectivity wherever you are. Before we get to that, the failure to do that, let's talk about like in terms of investment banking. How do they actually make their money? Let's like demystify that for, watchers and listeners.
There are different bits of the bank. So there are flow parts of the bank and there's asset management parts of the bank. So the way asset management works is people give you money, you manage it, and you take a percentage. So the amount of money you make is just the percentage times the amount you manage. So that's an asset gathering business. Wealth management, same story. Someone with 10 million to invest comes to your bank. You say, well, this is the service we'll provide you. We'll look after your money, but we'll take, say, 90 basis points, 0.9% of your wealth every year. So that's the way that business works. And really, once someone becomes a client, well, you'll be skimming off their wealth and you just want the client to stay with you. So you provide just enough service so they stay with you, but you're still taking a fair old amount of their wealth every year. So that's the wealth management business. And then you've got the flow business, which is essentially market making. So let's say you want to buy a stock. Well, we'll be the market maker for that stock. So we'll sell to you at a high price and we'll buy from you at a low price.
Okay.
And that's the bid offer spread. That's how we make our money. So the amount of money we make there, it's kind of like a supermarket where you get as many sales as possible. So it's the spread between the buy and sell price multiplied by the number of trades per day.
Okay, wow.
So the incentive there is to get the clients to trade as much as possible.
Interesting.
So when you see research published by an investment bank, by a platform, best buy lists, oh, look, this stock is hot, this stock is not. What they're trying to get you to do is to trade more because that increases their profit.
Interesting.
So that's the important thing to understand.
That's so interesting because I'm the victim. I'm not the victim of an investment bank high fees, but I'm the victim of seeing the research that you're talking about. In terms of, not really a victim, I'm just kidding. But I've seen those like best buy lists that you're talking about, and I think one of my first ever investments was I think it was an index fund on one of those lists, 50 best index funds to invest in. That is interesting.
So I'm the worst possible client because I hardly trade at all.
Yeah.
I completely ignore the research that they publish. And so, I probably don't generate a lot of money for them. But the thing is, they still make money on the stuff you've got invested. They can lend out your stocks, your funds, and that way they can generate a profit from that.
Wow.
But yeah, I don't think I'm very profitable. Not for the
you don't think you're profitable, but then isn't it like the bigger your sum is, then still for them it's still quite sizable, right?
That's right. They make a percentage on that. So it's a fee business if it's a platform in the UK. Some of them are percentage fees, some of them are fixed fees. What a lot of people don't realize is the more wealth you have, the more you have to invest. It becomes more beneficial to have a fixed fee platform. So something like Interactive Investor, Invest Engine, Trading 212, all of these platforms, they have a fixed fee. It doesn't matter if you have 10 million invested, 20 million, or 10 quid. You pay the same fee. So that becomes really a good idea once you get beyond a certain point, about 60, 70K.
Okay.
Below that, a percentage fee makes more sense. It can be cheaper.
Yeah.
So, it really depends how much you've got to invest, which platform's cheapest.
Yeah, and fees are very, very important. And I'm glad that you highlighted the point of, in terms of somebody building their wealth and to actually watch out for fees. And we're going to talk about it a little bit later because you could be losing out on thousands per year, right?
Some people are just, they just don't believe how much they're paying.
Yeah. Because
they just assume that it won't be too much. They also weirdly assume the more fees you pay, the better the service you get. Which is not true, which is very counterintuitive. Because, you know, if you buy a car, a sports car, or a fancy suit, the more you pay, the better the quality of that thing. Whereas with investment, it's exactly the opposite. The lowest fee funds, the lowest fee platforms are usually much better for you. So really, I think that's why it's difficult for people to get used to it, because they think, oh, there's some kind of cachet. If I pay for an expensive money manager like St. James's Place, for example, that's a very kind of high end. They kind of pitch themselves as a very high end service, but you could end up paying very high fees if you go with them.
Yeah, so it's important to look at the fees.
Definitely. Yeah.
No, thanks for breaking that down for us, because that is important. So with that being said, how does that impact an investor, or how should a potential investor think about how this could potentially impact them, the way that this, I guess the investment bank works, the way that fund managers make money?
The way I see it is it's very much like harvesting, as if you're a farmer, right? So you've got capital. It's kind of like seeds. You put the seeds in the good ground and they grow, right? So you get a certain yield every year from your investments. That's like your crop. Now, the money managers are kind of like the crows that come along and they eat all of your seeds. So the trick is to minimize how much you give to the finance industry and make it as efficient as possible as harvesting that return on the assets themselves. Okay. So the less of these kind of, I don't know how to describe it really. There's no polite word for it. Vermin. Financial vermin. Okay. You want to keep them away from your money.
Yeah.
So I think that's the trouble. If you've got a large amount to invest, they're really keen to get between you and your money and siphon off a percentage of your wealth every year. And it's your job to try and stop that.
And I think this is where it's important for you to have a good. Now, if you want to pay somebody a fee, that's up to you, but you should understand that there are some people not paying those fees and eating that for themselves. Or there's some people that are paying, not paying that, and then they're eating it for themselves. And I think I'm going to be the type of person that won't be paying high fees, because I don't feel like I need to, right? I mean, the information's all out there, unless it's like crazy, like unmanageable, I don't know, hundreds of millions. That's different, right? Where it's like, okay, well,
I have clients who have that as well.
Okay.
And I think the point is that I think people confuse investing and complexity. They assume that if you're a sophisticated investor, you're going to have a complex portfolio. There'll be some fancy risk management system, maybe have derivatives, whereas the truth is, for most people, 2 or 3 funds will get you to where you need to be. For me, for my portfolio, my core portfolio, I've got one fund. One. That's it. One global equity fund. And that's all I own.
Okay.
And that gets me to where I need to be, I think.
Yeah.
So I think people in the industry try to make it seem complex because then you can't do it yourself.
Yeah.
Whereas the truth is, it's not that hard. It really is easy to do it, as long as you keep it simple. And if you keep it simple, you still get the return. So, I think that's the big misunderstanding.
Yeah. And we're going to talk about that.
Okay. Definitely.
We're going to definitely help people with that, because I think that's very interesting. I wanted to know from you, your 12 years in, actually it's technically 15. In 15 years in investment banking, right? What would you say is like the wisdom that you've kind of gained and the key insights that you kind of learned from that time being in investment banking?
I think one of the things I learned during the financial crisis was the importance of liquidity. And now that's a pretty weird word. It's nothing to do with, water.
Yeah.
So it's not about that kind of liquid. It's about being able to sell something quickly and cheaply. Yeah. Now, if you've got an investment, say it's a house, and the entire housing market goes into free fall, it becomes really difficult to sell your property. And that's called illiquidity, right? So it becomes expensive to sell. It takes a long time to sell. And in the credit market, for example, with corporate bonds, exactly the same thing happens. If there's a crisis, you can't sell that paper. And that's a big deal. Whereas with stocks, you can sell them almost instantly. It's very unusual not to be able to sell stocks. So they're very liquid. Government bonds, very liquid. So I think when there's a crisis, that's when liquidity really matters, because you can sell if you want to.
Yeah.
It's not usually a good idea to do it. Usually it's best to just hold on. But the liquidity is really important. And we had these credit products that the bank was structuring, selling, and there was some fancy maths behind it to work out exactly how much it was worth. You do Monte Carlo simulations and come up with the price. But in actual fact, when there was a crisis, you couldn't sell this stuff. The price was just theoretical. If no one was willing to buy it from you, the price is irrelevant. So I think liquidity is important. And I think macroeconomics is important as well. Because if you're in a bad macroeconomic environment where there's a recession or high inflation, it affects everything. And I think having an understanding of macro is really important.
Yeah.
So being as part, I was part of a macro team. There were really talented people, economists, strategists, and I just learned so much from them about the way the financial system works and the plumbing. If interest rates go up, it's good for this, it's bad for that. Oil prices, if that goes up, good for this, bad for that.
Yeah.
So I think understanding how everything fits together, that was so valuable.
Wow. Coming into 2025, I was reflecting on one of the best decisions I made for my business in 2024, which was setting aside just a few minutes to open a business savings account, which would get my money working for me. Personally, I had business funds sitting idly in a current business account, earning no interest at all. So when I found Ts instant savings account offering 4.07% AER Variable paid monthly, I knew I had to act fast and open an account. Now I'm eagerly looking forward to seeing how much passive income I'll earn on my business funds when the interest rolls in at the end of each month, all without lifting a finger. Tide, who is kindly sponsoring this episode, is giving any new members who sign up and use my code SAVVYWALLET £100 when you fund a Tide instant savings account with £5,000 within the first 30 days. So you get £300 plus a 4.07% AER variable on your business savings. You could potentially be earning hundreds of pounds a month. I also know that peace of mind as a business owner is essential, and with Tide's instant savings account, I feel reassured in the fact that I can withdraw business funds instantly through the Tide app. I get FSCS protection on up to £85,000. It has unlimited deposits, no withdrawal fees, and a current account isn't required to open it. Opening a Tide instant savings account is easy and only takes 4 steps to set up the account. If you're interested in this special offer, tap the link in the description of this episode and make sure to use my code SAVVYWALLET to get the £100 bonus. 2025 is the year for putting your money to work. Terms and conditions apply. For full details, please visit tide.co/terms/SAVVYWALLET You'll find a link in the description box below and displayed on the screen. Rates are correct as of 17th of December 2024. I just wanted to ask for clarification for you, because just in case people don't know what it is, when you say macroeconomics, what does that mean?
So that's essentially growth, GDP growth, interest rates, and I'd say probably inflation. Okay. Those are the three big variables which essentially capture macroeconomics. Yeah. And there are lots of things which feed off that, but those are what drive asset prices. They drive growth. They affect whether you're going to lose your job. If there's a recession, you get job insecurity. So it really matters, this stuff, and understanding it, and recessions, and what happens when there's a recession. Yeah. And why there's a recession, that's kind of interesting too. And inflation, that we've just had this inflation spike, which affected everyone negatively. And the reasons behind that, I think, are kind of interesting. Yeah. So understanding that, I think, is important.
Yeah, yeah. And I think the data to get that is not too hard, and it's not complicated to know what GDP is. I think most people should know what GDP is. Most people should understand what the inflation rate is. And what was the other? There was one more I'm missing.
So you got growth, inflation,
growth,
and interest rates. Those are the three.
Yeah, and we all have to interact with interest rates if you're doing some form of borrowing, right? If it's a credit card, if it's a mortgage, if it's a loan, you have to understand what that is. So there's almost no way for you to avoid this? I mean, if you want to be ignorant, sure, but it's not going to be great for you.
But even if you're not a borrower, interest rates affect you because the way to think of it, if you've got a risk-free rate, and that's what you call government borrowing, right? It's kind of the risk-free rate. If that increases, well, suddenly the hurdle to buy something becomes much higher. So let's imagine interest rates are zero, like they were not long ago. Well, if you buy gold, it doesn't give you an income, but you don't care. So, you could either buy government debt, which pays you nothing, or gold, which pays you nothing. So gold's just as good as government debt in that environment. But now let's say we switch to today, where you can earn almost 5% risk-free by lending money to the government. Well, gold suddenly looks less attractive, right? Because it doesn't pay you anything. So immediately, gold becomes less attractive, and that pushes down the price of gold usually. So interest rates affect the value of gold because it's a wasting asset. Same thing for equity. If equity pays you a 3% dividend, well, okay, you get the capital gain, but I could earn 5% just sitting in cash. So interest rates affect everything. Inflation affects everything. Inflation is really what you have to beat long term. And growth will affect your prospects and how much money you can make.
Thanks for that explanation. That's a good way to explain like how interest rate can affect you even without like you borrowing. Wow, that's so interesting. So let's talk about like investing, and we can explain some of these terms of what a bond is, what investing is. Start with the first question. What actually is investing when we talk about investing?
Well, I think it is like harvesting risk premium. That's what they call it. What is risk premium? Well, it's the additional return you get above that risk-free rate for putting your capital at risk by buying something. So let's say you buy NVIDIA stock, right? So you've got your hard-earned capital, you buy some NVIDIA stock, and immediately on day one, you can bet the price goes down. Every time. It's like a universal law. When you buy something, the price will go down. And it's volatile, right? The price goes up, it goes down, and your capital's at risk. And in order for you to put your capital at risk, you have to be compensated. And for stocks, because they're so volatile and uncertain, the risk premium is very high. So look back 120 years, and stocks generally generate a return that's about 6% above inflation. Which doesn't sound like much.
Doesn't, no.
But if you actually look historically, it's been unbelievably good. Compare that with something like gold. Well, that tracks inflation. So you just earn inflation on average for gold. Whereas with bonds, you do get some risk premium. You get about 2% above inflation, maybe 3%. And a money market fund, just a tiny fraction above inflation. So that's a very safe investment. So generally, the higher the risk you take, the greater the return you get. But you pay for it by sleepless nights because it's like a roller coaster. You know this. You buy stock and then you look at it the next day. Oh my God, it's gone down.
It's tough.
It is
a bit
tough.
of pill to swallow sometimes.
But if you are willing to put your capital at risk, as long as you don't take too much risk, and it's about choosing the right risks and diversify your risks, then you can achieve a very good outcome if you're patient and you don't freak out.
The risk-free period, can you explain what that kind of means in a way? I think I've got an image in my head, but I kind of want to hear how you explain that.
Think of it like a magic money machine where you put £1 in today and a year later you get £1.05, say. So it's a 5% increase, but that is guaranteed. How can you ever guarantee it? Well, you lend money to the government. Now, the government, in the UK at least, can print money. So it is risk-free. They can just print more money to give you that 5% return.
Right. Okay.
So the safest thing you can do usually is to lend money to the government, and you do that with government bonds. So that defines the risk-free rate.
Right.
Now, any other lending you do, so let's say now you're going to lend to a company for a year. Well, I can earn 5% risk-free by lending it to the government. I'm not going to lend it to a company which might default on the debt. They might not repay me for less than 5%. So on top of that, you layer a risk premium. So if it's a really dodgy company, it could be 5% higher, right? So I'll get 10% from that company. but it'll never be less than the government. It's very unusual for that to happen. It does sometimes happen, you know.
Okay, that would be weird.
But it is weird, yeah.
Why would you put money into that?
Well, I think people just feel that company is very safe. Microsoft, for example, was trading below government rates for a while.
Yeah.
Johnson & Johnson, a very high credit quality company, but it is unusual. It is unusual.
Okay, I understand now. Okay, so it's like the rate of return that you get from investing in a government bond, which we're going to explain what a bond is later, that sets like the baseline, right? So, and if you want to invest in any asset that is riskier than that, it's usually you'll get a premium for that risk.
Yeah, think of it like a cake. You've got the risk-free rate. That's like the sponge on a vanilla, you know. So that's like the sponge on a Victoria sponge. And then layered on top of that is the icing.
Okay.
And that's the credit spread.
Yeah.
Which you get for the compensation in case the company goes bust.
Yeah.
And so always you're thinking, is this sufficient compensation for that risk? And if it's not, you don't buy it.
Yeah, I mean, 5% is quite good, to be honest with you, right?
Just for sitting in cash. It's incredible.
It's very hard to ignore that, even at the risk of, yes, you know, stocks are more, but it's like, but 5% is a good rate, considering we haven't had, I mean, interest rates are now near that. So, but before, like a few years before COVID, interest rates were nowhere. You was not able to get that. So,
yeah, it was sub-zero. I mean, a lot across much of the world, the risk-free rate was below zero.
Yeah.
So if you wanted safety, you paid for it. Literally, you paid the government in order to lend the money. But people were willing to do that for safety in some cases.
Yeah.
But we've left that world.
Yeah.
You know, I think that's probably a world we're not going to go back to.
Yeah. Ever, you think?
Unlikely for a long time.
For a long time. Yeah. Oh, that's sad. Should have made use of it. Okay, cool. So we mentioned a few terms, equities, bonds. Starting with equities, what does equities mean when we say we're investing in equity?
So equity is the most risky kind of investment in the sense that if the company goes bust, you're buying a slice of a company, right? So let's say it's NVIDIA again. You own a part of NVIDIA as a shareholder. Literally, you are the owner. That's capitalism, pure and simple. Okay, you own a tiny slice of NVIDIA, but that share gives you a vote at the company's annual meeting. So along with the financial benefit, which is the price goes up, you get income. So if it pays a dividend, you get paid a dividend as a shareholder.
Yeah.
And if its capital increases, if it's capital, you get a capital gain, so much the better. And NVIDIA has been unbelievably good for generating capital gains, not so much dividends, but growth.
Yeah.
So that's what you get as a shareholder. You get a ownership of a slice of the company. And it is real ownership. You get a say in what they do.
Yeah. Yeah. And the apps are good at doing this. Like, so I think some people know this. I'm with Trading 212 and they're quite good these days of sending you. I remember when I first had it, there wasn't, but now for pretty much all your investments, you're able to like you say, dial into meetings, and then vote on board meetings and stuff like that. So it's very, very interesting. Thank you for that explanation. And then bonds, how does equities differ to bonds?
So bonds are tradable chunks of debt. So you can sell it to someone else, or you can wait until you get repaid the debt.
Okay.
So let's say it's a 5-year bond. You pay for it today. You get coupons, which are the regular interest payments. And then when it matures, you get your money back.
Yeah.
Assuming it doesn't go bust, right?
Okay.
So that's the risk. If it's a corporate bond, it can go bust. If it's a government bond, it's very unlikely to go bust. If it's a UK, say. We haven't defaulted on our debt for a long time.
Really? How long was that?
It's been centuries.
Oh, wow. Okay.
It's funny, in the Middle Ages, we were serial defaulters, so that's when we were kind of like an emerging country. And
we were an emerging country.
Oh, yeah.
True. Yeah.
It was based on wool. That was our big export. It was wool into Europe. And then we had lots of wars, which were expensive, and we defaulted on our debt, unfortunately.
Okay.
But, now we call them gilts because they used to have a gilt edge around the outside because there was such high quality.
Okay.
And we wouldn't default on it, right? I mean, you could say we beat Napoleon because our debt was more marketable than his. And essentially it came down to money. We could raise more in the battles, to fight the battles, to buy the materials you need for a war more effectively than the French could. So debt really matters.
That's interesting.
So you've got to have debt which is people want to buy.
Yeah. So a bond essentially is the government. It sounds strange, but it's like the government borrowing money from you. Right?
Well, it's you lending them money.
Yeah, you lending them
money.
You
lend them money, and then they can go off and spend it to run the country.
Yeah.
That's the idea.
It's so interesting, right? It sounds weird to say that, right? That you're lending money to the government.
And the money's, the governments are now big borrowers. You just look at the debt relative to the size of the economy. And in the UK, it's roughly the same size. It's 100% of the annual GDP. In the US, it's 120%. So it's slightly more than the size of the economy. And in Japan, it's like over 250%. So these are highly indebted countries now. So the debt, there's a lot of worry about that now. People are worried that some of these countries will not be able to repay it.
Yeah.
And they just kick the can down the road every generation. The debt just gets bigger and bigger.
I mean, if you could imagine that was a person, right, that was borrowing more than they had like 100K debt and they was earning like 50,000 a year. You would say to that person, you're gonna struggle. You got some worrying times ahead. That's what you would say if it was an individual. So for a country to be like that.
Now a country can print money.
Yeah.
That is the difference.
That's the difference. We can't,
So that's the difference. And if there is a deficit, then effectively they're putting money into our pockets. So, debt's not a bad thing as long as it doesn't get out of control.
Yeah.
And the thing you look at is that debt to GDP ratio. So the latest budget that we had from the Labour government, for example, they're obsessed with repaying the debt, or at least not increasing the debt to GDP over a 5-year period. And you can change the definitions so you get a bit more wiggle room.
Yeah.
But they're really careful about that, which is good in a way. It keeps gilts as something which is high quality. It stops us being an emerging country, essentially.
Yeah.
And of course, emerging countries do default on their debt. So if you want a bit more juice, you can actually buy the debt of emerging countries, and they have a credit spread because they default. So if you buy Mexican bonds, Mexican government bonds, you will get a higher rate of return than you would for UK, say.
Yeah.
So some people invest in that. They buy EM, they're called EM, emerging market bond funds, because you get the credit spread. You get the icing.
Yeah, so they're willing to take a bit more risk and get a bit more icing.
But you can get 6%, 7% rather than 5 at the moment.
Honestly. And we're going to talk a bit about risks as well, because I think it's very important to kind of understand what the risks are. So I guess, obviously, us talking about investing in equities, in bonds, why is it important for people to invest, I guess?
I think not everyone has to. And I think a lot of people get confused about this. When they talk to me, they kind of say, okay, we do a power hour. We join, they join the Zoom call and they launch into their portfolio. And you just think, wait, why are you doing this? What are you trying to achieve with this? And I think many people get this wrong. You should start with your goals, whatever they are, and work back to the portfolio. And what do I mean by goals? It's what you want to do with the money. Do you want financial independence? Do you want to just turn around to your boss and tell him to stuff his job? In banking, we used to call it the FU number, when you could turn around to your boss and say, FU. So that was an important number, because once you reach it, you're working because you want to work, not because you have to work. And I think that's important. So once you've worked out your number, you can think, well, how much am I going to have to invest to reach that number in this amount of time? You'll never know it exactly, but because you know these long-term returns from equity, from bonds, from things like gold, you can work out roughly how long it'll take to get to your goal. Now, there's volatility. There could be a crash, which stops you getting there in the time you expected, or it could surge upwards like it has recently. And you could suddenly find yourself there. Now, if you didn't know you'd reached your goal, then you could carry on investing, taking too much risk, when really what you should be doing at that point is de-risking.
Yeah.
Because you don't need the risk at that point. You just need to beat inflation. So I think knowing your number, knowing your goals, tells you what portfolio you need to get to a certain point. And that's what people often get wrong.
Yeah. And I appreciate you for saying the fact that you have to define your investing goal, because there's going to be a lot of people watching and listening to this, wanting to start, investing straight away, but they don't necessarily know why they want to invest. They don't know how long they want to invest. They don't know how much they want to put into it. They don't know the amount they want to kind of get into, but then they're kind of ready to invest. And like you said, I think that is the wrong way, because if you don't have that, you might just be investing forever. And there's nothing wrong with that, but then you are sacrificing today for the future. So I guess you got to understand what you're sacrificing for, in a way.
And many people, I speak to so many people, and everyone's goals are different. Some people, it's all about what we call terminal wealth, which sounds a bit grim. It's how much money you've got when you die, because you want to leave it to your kids or some kind of cause. Other people say, screw my kids. I've given them a good upbringing, good education. They're lawyers. They don't need my money. So I'm just going to spend it on me, So, and some people, they're obsessed with a certain thing. Like the most focused people I talk to, weirdly, is people who love boats. Like there was one couple, they said, look, we can't talk next month because we're about to go on our next cruise. And they just have this yacht. They sail to the Far East and they just live on the boat, and they live to go on the boat. That's their life. So...
Oh my gosh.
But that's why they invest, in order to maintain that lifestyle.
That's so interesting.
It is interesting, isn't it? People are so different. Other people are obsessed with how much they're going to have for their kids. Other people, they've got a huge amount of money.
Yeah.
And really it's a matter of they're the guardians of the money for their family. Essentially, they're running an endowment scheme, and they just want to make sure that they do something sensible with the money as guardians, which is very stressful because you're, as a guardian of the money, you have to not screw up. So they talk to me about how they should invest, and we kind of talk about the allocations and the risks they're taking. But, all sorts of people, some people with very little, some people with a lot, some people who've been scammed, and you just hear these awful stories. Wow. Some people who've had really bad experiences with wealth managers who gave them bad advice. And you just hear stories and think that can't be true. That's awful. Some people who are about to die, so you I speak to some people who've got terminal cancer, and the investment horizon is very short, but they have to get things in order for their family. So it's a very different story. So really it's about investment horizon. Who gets the money? Is it you? Is it your family? And what kind of risk do you have to take to get there?
Yeah. And it's a very important. Thank you for bringing that to life, because I think that humanizes it a bit more in terms of investing and how it's so varied for different people. Because I think sometimes when we do talk about it, maybe it might come across like, for instance, my goal might be your goal, but it's not actually the case, right? My goal is my goal. I might be looking to retire in 5 years. I'm not, but I might be looking to retire in 5 years. Somebody listening to this might be looking to retire in 2. No, I'm kidding. Well, in 10 or whatever, right? So it's different. So I think that's very important to understand that goal. One thing that people don't talk enough about, though, is the other side of investing. Once you get to your goal, what do you do? I do get some questions about this. When do you sell? What do you do? How can people figure that out? Like the big question of, okay, I bought, it's gone up, whatever. When do I think of selling my investments or living off it or do whatever I want to do with it?
I think that's the goal, right? So that'll tell you when you need to sell. And really, that should be the answer of when you sell. You should really hold it forever, your investments. You should have a strategic goal, so you've got your portfolio. And really, I think having time buckets helps. So you say, this is money I'm going to need in the next 5 years. Well, if you need it in the next 5 years for a deposit, for your education, you don't put that capital at risk. You put it into something really safe, like government debt, like a money market fund. If it's money you're not going to touch for 10 years or longer, well, who cares about volatility? Yeah, it'll go up and down. But if you put it into equity, you get a much better return long term. So I think that's really important, knowing when you need the money. But really, it should be about that. You should be saying, I need the money to live. That's why you invest. It's so you can have nice things. You can have a choice about what you do in life. And I think that's what retirement is really. It's not a holiday. It's not saying I'm going to stop work. It's about having a choice about what you do in life. Like you could say that my job now is a retirement job. You know, I've got enough to live off now. If I stopped working, I'd do it because I love it, you know, and that's great. It's a really empowering feeling to feel that I don't have to do this, you know, but I do work weekends and I do work crazy hours because I love it. Yeah. You know, and I think the biggest thing is when people talk to you and say, you've changed my life. You know, I was paying huge fees. You've actually saved me thousands of pounds. I was so stressed about my portfolio and now I don't feel stressed anymore. You know, I don't look at it so often. I know roughly what's going to happen. I understand what's happening because I understand the economics. I understand the portfolio. Yeah, it's volatile, but I have to kind of have a Zen approach to that.
Yeah. I love that. I really, really appreciate that because I think it really explains to people why you've got to, again, set your own time horizons on what you want to do. And I do also agree with the, you know, if it's less than 10 years, like investing in stocks is probably not the way to go. And so, but some people are going to still try and gamble stuff in 5 years. You know, that's just the way it is, right? We'll give them the warnings, but they're not going to listen to us.
Oh yeah. I mean, sometimes you speak to people and they say, look, there's been a tech wreck. I've lost 50% of my money. I put it all into this stock. And you kind of have a discussion with them. They go away. And then next crash, you have exactly the same conversation. So some people don't change their behavior. Other people learn from these experiences. So I think it really depends on psychology.
Yeah. And talking about psychology, right? I think it's one of the most important things when it comes to investing. Like I was saying, towards the beginning of this conversation, it can really, even a seasoned investor can get it wrong because there's so much happening. There's so much noise. You just never... The truth of the matter is none of us have a crystal ball, right? Even when we know the stock market will recover, like COVID, even when we know, during the time, it's like, because that was so unprecedented in what was happening, it's like, okay, what's seriously going to happen here? But some smart investors knew, okay, nah, we'll bounce back. But so it can be a bit tough, right? So fear of missing out, that's going to probably be happening a lot. I mentioned Bitcoin, Nvidia, Tesla, all of these are assets that have gone up lots in value, right? So how can fear of missing out occur when it comes to investing in the stock market?
Oh, this affects everyone. It affects me. So what I do is I set aside 10% of my money and I have a fund portfolio. So by fun, I mean lose money, right? So I keep this portfolio to remind me that I'm not clever because every time I try something that's a little bit weird or a little bit of a fancy strategy, I get it wrong. You know, it all starts off really well. You know, you start off with good intentions. So, for example, I've got a basket of stocks for copper miners. The logic is that we're electrifying the world. We've got wind farms being built. Almost everything requires lots of copper. Every electric vehicle requires lots of copper. So there'll be demand for this, yeah? There's finite supply. So it should go up, right? The price of copper. But this basket is all over the place, right? So you know, you have theories, you implement them, and it doesn't pan out. So often that's the case because of other reasons. So I keep the fund portfolio so that I can try stuff out. I can try and beat the market, but it often doesn't work. But it's fun and I learn. Whereas for my core portfolio, which is like 90% of my wealth, it's just that one fund. I'm not going to learn anything from that. There's no fun, but it does the job, right? So the fund portfolio is kind of like giving your toddler an iPad. You know, it keeps them out of mischief. It stops them from putting a screwdriver into the plugs. And it's the same for me. The fund portfolio takes up my time. I learn stuff. I lose money. Sometimes I make money. But I always learn that it's very difficult to beat the market.
So you're essentially like, you know, if you ever have that feeling of FOMO, fear of missing out, you have that, your fund portfolio to be like, okay, if I'm feeling this, I can try and invest in this portfolio. away from here, 90% of my wealth is on the other side. I'm not risking that, but I'm willing to risk a bit of this 10% here on the
like crypto.
side.
You know, I've got a little bit of crypto, but it's enough to hurt if I lose money, but not enough that it's going to screw up my entire wealth. So I think that's important, having the fund portfolio. Yeah, because you know, you want to learn about markets, you want to try stuff out, but always keep score, right? So see how well it performs relative to your core portfolio. Yeah. And chances are that you won't beat that, but you know, you'll learn stuff and you have fun.
Is 10% like a number you should try to stick to, especially if, let's say, like you're a beginner, right? You really shouldn't be looking at more than 10% of your wealth in, you know, in investing in stocks or, you know, smaller companies and stocks or smaller companies and stuff like that, right?
Well, the way I do it is I think of it this way. What's the probability that I can beat the market, the global equity market? For me, I think the probability is about 10%. So that's why I keep 10% in the fund portfolio. And I'm brutally disciplined about that fund money. You know, that's got to stay that small. Yeah. And if it gets too big, I sell a bit. So you've got to be brutally disciplined, I think, because if I was convinced I could beat the market, it would be 100% fund portfolio. I'd have single stocks. I'd do stock picking, bond picking, really active portfolio management where I'm sloshing money from this to that. But I just know that I can't beat the market, you know.
But a lot of people think they can, and we're going to talk about this because I think it's very interesting, right? So, you know, the other factors when it talks about, you know, in terms of psychology of investing is, I mentioned it before, so the stock market crashing, and we were talking offline about there potentially being another crash. There probably will. It always happens, right? The stock market always crashes. Like, that's the history of it. How can people kind of work through that fear of it happening? We know it's inevitable. We know it's going to happen. And we also know that there's going to be a lot of people selling their investments during that time, which is like the worst time to do it, right? You're selling it at a 50% discount. It's almost like, if we use property again, it's like you selling your property at 50% discount. Like, imagine somebody doing that. If I said that to somebody, oh, I'll offer you 50% off on your property, you'd be like, go away, Atto, you kidding, right? That's the same thing, but people still do that. So how can people manage that kind of, I guess, sensation and feeling?
It's difficult. And the natural reaction when there's something like a crash is fear. And when you're scared, you pull back. You want to sell. That's the natural instinct. And that's built into us. You know, if you see a saber-toothed tiger in the bushes, you're not going to run towards it. But in the stock market, you've got to run to the saber-tooth. You've got to keep hold of your existing investments, knowing they'll recover. And if you've got spare cash, you buy more. You buy more equity because it's a sale. Yeah. So I think what you've got to do is refocus or kind of reinterpret what's happened as a sale. So what I keep is a market crash shopping list. So these are things which I like, but which are currently too expensive. So Nvidia, maybe. Nvidia stock, currently it's at crazy valuations. But if there's a pullback in the equity market, I might buy some. Or, you know, copper stocks, that's another one. Or it could be AI as a theme. I could buy AI-related stocks. Generally, whatever is the epicenter of the crash is where the biggest bounce back is. So, for example, if we go back to 2020, energy prices, oil prices went negative. So the futures market for oil, you were paying people in order for them to buy your oil. Wow. Which was crazy. But it was very brief, but it happened. So it didn't take a genius to work out that, do we still need oil? Yes. Will the oil price bounce back? Yes. Is it a huge opportunity? Yes. So I think that's important. Be tactical. When these opportunities come along, if you've got cash, deploy it. But whatever you do, don't sell your stocks. Because they always come back. Yeah. But it is difficult. Yeah. So just think about the sale aspect. Don't freak out. And if you have got a diversified portfolio, you're fine because you'll have stuff in there which hasn't crashed. So as you approach retirement, that's why people de-risk, because at that point, you need to have safe stuff to live off. Because if your equity's halved in value, you'll be depleting your pot really fast.
Yeah, which is a bad time, right?
Worst time.
Yeah.
So that's really sensitive point in your life. You can think of your savings as a kind of shark fin. When you're a kid, you've got nothing. When you're kind of 55, just before retirement, that's when you've got the maximum wealth. And then you slowly deplete the wealth as you live off your investments in retirement. So it looks like a kind of shark fin.
Yeah.
So the point when you're most sensitive to a crash is when you're at the tip of the shark's fin. And that's when you really should de-risk before that.
Yeah.
And what I often see is people come to me and they say, look, the market crashed. I feel awful. The time to de-risk is now, because now is a time when you can sell the stock at a high price and find an asset allocation that you're comfortable with. So imagine that there's going to be a 30% fall tomorrow. If you had money in a money market fund, it wouldn't fall. If it was in government bonds, it probably wouldn't fall either. So before that happens, let's say that there's a 30% fall. How much would you be comfortable losing? And if it's nothing that you want to lose, then you'd put it all into the money market, but you'll get a lower return as a result. So really that's the trade-off. The time to de-risk though is now. It's not after the crash. So that, I think this is a good opportunity when markets are kind of exuberant. And that's when nobody would consider, taking risk.
Everybody's waiting because it's greed. That's the other thing, right? This is like two angles, right? When it's down, you're ready to sell. When it's up, you're ready to buy more.
Yeah, as Warren says, Warren Buffett, be greedy when other people are fearful and vice versa. Fearful when people are greedy. And at the moment, people are greedy.
Right now, people are so greedy. It's very hard. And even that psychology, because I have that as well. I'm like, when it goes to, let's say you get 100%, you double your money. Let me wait for 150 to, it's such a tricky, you have to just make peace with it. Honestly, you have to have your targets. You reach your targets and try to not be greedy, because yes, it could still go up. But then what if it goes down? Then you're like kicking yourself, I had the chance, and then it crashed, and you're like, oh my God, I've got my money stuck in here.
So those are the two things, I think. You've got to work out your risk capacity, which is if you have a loss, how much of a loss can you weather without it affecting your lifestyle? So if you've got an investment you're not going to touch for 10 years, who cares if it crashes? It's not an economic risk. It would be if it crashed at the end of that period, which is why you de-risk at that point. So the other aspect is the risk appetite. So that's the psychological impact of a crash. And that's much more difficult to manage because it feels terrible. It feels like you've been punched in the gut when you make a big loss. That's your life savings. You've sweated for that your whole life, and suddenly it's worth half of what it was. And that can crush people psychologically. And they feel also, because they've got the wealth of the family, that they've done something wrong, whereas they haven't. What they've actually done is sensible, and they just didn't understand the risk. So I think that's what's important to understand. What's your risk capacity? What's your risk appetite? Those two things determine how much you should put into stocks, how much into safe stuff.
Thank you. It's a very important thing, because when people start investing, they're going to go through these sensations. There's almost no way to avoid it, even like with ETFs as well, right? Like, so the global, I'm investing in a global one, and that had a big, I'm pretty sure I mentioned it in the podcast recently, I think it was in July, August, had a pretty big drop. I think it was like 5% in a day or 2 days, which is big for something of that size. And I can imagine there would have been a lot of people panicking, and I was buying more. I was like, I'm buying more. I don't care. Like, this is, I wasn't, not intending to sell it anytime. I was like, wow, I can't believe I got like, this is like a deal of the century. Honestly, that's how I felt. I was like, what? Like, how did it get to this price? What's happening? Why is it so like, okay, I'll just buy more? So I think you have to deal with it. There's almost no way you're not going to deal with it if you're investing in a stock market. In terms of discipline, how can people be more disciplined? Because that's also a hard thing for people to do in terms of, I think discipline works in the way of, okay, even if the stock market's down, I'm still going to, continue investing. Even if I feel like, I don't feel great, I'm going to still continue to, add more money.
I saw a great quote actually about this, which is, I think it was Morgan Housel who wrote The Psychology of Money, which is a great book, where he said, if you wrote the best book on investing would just be one phrase, shut up and wait. Because that's that's what's going to work for most people. And checking your portfolio more than once a month, I think, is the problem. And I speak to people who say, look, I check it every day, sometimes every hour, and I look to see what it's doing, which is kind of crazy because in order for it to do what it needs to do, it's really about two things. It's about patience and sticking with it. If you do those two things, the stock market's basically a way of taking money away from impatient people and giving it to patient people. And I don't think people appreciate that. But if you're patient, you stick with it long term, don't expect crazy returns, just expect a reasonable return for a long period of time and let compounding do its magic. I think that works for most people.
Yeah. That's the thing. I think it's understanding that, and I think it's also, like you say, I like the patience, the money going from impatient to patient, because that is what it's about. It is about being patient at the end of the day, right? Like maybe a company you're investing in, maybe it's not where it needs to be right now. Maybe it's going through a rough patch, and eventually it will, let's see, succeed, right? Like I even think of like Apple. Apple's gone through a lot of rough patches. Microsoft has gone through Amazon, Facebook. I remember at one point, nobody wanted to touch Facebook. Honestly, the truth is, I think most people even forgot that time happened. I remember it because I was an investor in Facebook, and I remember everybody's, Facebook is, their TikTok's going to take over. And it's so funny because everybody that was saying that on Instagram, and I'm like, all right, sure, but you're saying this on Instagram. So it's so insane sometimes. If you're invested in something, you see those shifts, but then other people forget that happened. Even this crash that I'm talking about that happened in July, I even forgotten the specific date it happened. That's how unimportant it was. It isn't so big. So yeah, I think it's very important. So for those people, right, that are scared of investing in the stock market and think that, I'm going to lose money, they're skeptical about it, what would be your message to them?
Look at history. Just look at a graph over 100 years of what happened to the stock market. And what you see is a line that goes from the bottom left to the top right. There were wars, there were pandemics, there were terrible economic crises, and it was all fine. So I think that's the thing to remember. And I think there's a great book by Dimson, Marsh and Staunton, which is called Triumph of the Optimists. Because if you look at stock returns, if you were someone who's bearish, you would have missed out on the entire ride up, right? It's incredible. You put your money into the stock market and, okay, it's volatile. But if you're willing to wait 20 years, the odds are very good that you'll make a good return on that. So I think that's very special. So I think look at history, look at the long-term returns and memorize them, because that's what you're going to earn if you're patient.
Yeah.
That's what's most important.
Yeah, it's super, super important. So I want to help people to make their first investment, right? So I guess what would be those steps? Say, let's assume somebody's defined their investing goal, right? Whatever it is. I guess what would be the steps for them to make their first investment?
I think you need a platform. It's like your tool of investing. Your platform is your kind of supermarket where you buy stuff and you monitor how well it's doing, and you can sell stuff eventually as well. Use tax wrappers. So use your ISA allowance. ISAs are incredibly flexible. And I do speak to people outside the UK who don't have anything like an ISA, and they just can't believe we've got something so generous. Mm-hmm. You don't pay capital gains tax on that money ever again. You don't pay income tax on that money ever again. And in retirement, you can top up your income with the ISA, and it doesn't count as income because it's savings. So it's incredibly
that's
powerful.
Actually very true. You know what? I didn't think about the other side of that. Oh, of course, absolutely right. Because it's a tax-free sum when you're drawing out of it.
You've already paid tax on it before it goes in, so you don't have to pay on the way out. Yeah, so it's brilliant. So use your ISA allowance as much as you can. If you don't use it, you lose it. You can't carry forward the previous year's allowance. You can do it for your kids, junior ISA, You can do it with your partner. Max those out because it's a real gift.
Yeah.
Then you've got the SIP, you've got the self-invested personal pension. Not so good for inheritance now after the budget,
Okay.
which upset a lot of people, understandably. But for a retirement saving, it's brilliant. Firstly, the money that you put in, if you sacrifice some of your salary, it reduces the amount of tax you pay on, now. And then that money can compound free of capital gains tax, free of income tax for many years. And then when you withdraw it, you do have to pay tax on it because it just forms an income. So those two vehicles are great. So try and put it in a tax sheltered account. Find a platform which is cheap. Now, how cheap it is depends on how much you've got to invest. Initially, a percentage fee makes sense. So it's a percentage of your invested amount. That'll end up being cheaper usually than a fixed fee platform. So, for example, if you've got an ISA on Interactive Investor, as we record this, I think you pay £120 a year for that.
Oh, right. Wow.
So,
Okay. It's a bit pricey,
but if you've got, say, 70,000 invested, you will pay usually about 0.15% on a Vanguard, say, for your investment. So that actually becomes cheaper to go for a fixed fee platform once you reach that level of investment. So the cheapest platform depends on how much you've got invested.
Right, okay.
Above about 70K, go fixed fee. Below that, percentage, usually better.
Cool. Yeah, because I guess at 70K, if it's just fixed at 120, it means it's never going up. Your percentage is reducing basically every year. Okay, that's so interesting.
And I speak to people who've got like 6 figures invested, and for them, well, 7 figures is like over $1 million. Well, for them, that £100 fee is almost nothing, right? Often they come to me after they've talked to a wealth manager where they were paying 1%, right? God, so imagine if you've got $1 million invested, you're going to pay 10 to the power 4, so that's 10,000 a year in fees. That's crazy.
That's crazy.
Compared to £100 a year to manage it yourself and keep it on the platform.
God.
You can save huge amounts of money.
Almost $9,000 just by moving and just doing this due diligence yourself. And the other thing as well, I think people also miss the amount of savings. Like you mentioned stocks and shares. I think people really miss out on how much you save. Because if you are doing that in an equivalent, just a general investment account, and you're trying to withdraw that in 20 years, first of all, you don't even know how much tax you're going to pay. That's the crazy thing. What if the tax is crazy, like 30%? Well, okay, now there's nothing you can do about it. You can't now try and transfer it over to a stocks and shares. So there's so many risks. That's one. You're paying tax versus no tax. That is a big deal. And I think a lot of people don't realize, because we were talking about it offline. I think it's roughly about 3% of the population have a stocks and shares ISA. So to me, let's say if we're not even including children in that, right? So probably roughly still about 50% odd don't have a stocks and shares ISA. So effectively you're going to be paying tax. You're going to be losing out in some way. So yeah, I do find it fascinating that more people are more comfortable with cash ISAs, but I just find it fascinating that we're not taking opportunities of, like you say, you speak to people around the world and they don't have this vehicle, and we have this vehicle where we can grow our wealth and it's tax-free.
It's unbelievable, really.
It's unbelievable.
And in retirement, it's so flexible.
Yeah.
You can carry on adding to it in retirement if you've got a lump sum that you get from whatever. So it's really great, I think, as a vehicle. And people really should use it as much as they can.
Yeah.
And you can do it for your kids. Another thing you can do for your kids is like a junior SIP. So you buy a pension for your kids. Now, I did a quick calculation, and because when they're a baby, it's going to be decades until they retire. So the compounding is just unbelievable. So if you contribute the maximum, which I think is about $7,000, and then it gets grossed up by the government because they assume they're a basic rate taxpayer, 9 years of contributions will get them to like £1 million in their pension over the course of their life. So, putting aside $9,000 for your kids every year for about 9 years is not that difficult. Yeah. So I think, a junior SIP is another thing that people do for their kids.
Yeah.
But imagine that if you grow up and you just think,
Yeah.
I've got a pension when I retire, which is going to be maxed out.
Yeah. It's so important. It's so important. So, okay. So the steps would be choose your kind of investment platform and then figure out like, obviously getting a tax-free wrapper type of account. So stocks and shares ISA, a SIP if it's for kids, junior ISA and junior SIP, right? Okay, cool. And then from that, once, let's say they've assumed they've done that, how do they kind of then make their first?
Well, then you've got your goals, right?
Yeah.
So you work back from your goals. So let's say you want to retire when you're 50, right? And you're currently 20. Well, work out how much income you want. And roughly people use the 4% rule. So if you've got £1 million, you get an income of 40,000. That's the way it works. Because if you withdraw 4% and the pot is growing at 6%, which it would if it was equity, well, on average, the pot won't shrink. That pot will last forever. It's like these magic pots that you have, in stories where you kind of just take money out or take food out of the pot and it never depletes, So that's a perpetual pot. So if you want that money, you want that income, you know how much you have to invest to generate it. So the 4% rule is quite useful as a rough rule of thumb.
Yeah.
So know when you're going to retire, know how much you're going to need when you retire to generate the income you need as you see it today.
Yeah.
So once you know that number, you can start to work out, well, if I save this amount every year, and if stocks go up on average 6% in real terms, that's after you've subtracted inflation, you can work out in a spreadsheet how long it'll take to get to your FU number when you've reached your goal. If you've got money that you're going to need over the shorter term, don't put it into stocks. Put it into money market funds or UK gilt funds because those are much safer. With the gilts, go for short duration because they're less volatile. And you can buy funds which have that property. But you can see now that you really just need 3 types of fund. A global equity fund to generate the long-term returns, which is fully diversified. Literally, you buy the entire global stock market, or 80% of it. And then a safe bucket, which is your money market fund or your government bond fund. And that's the kind of safe component of your portfolio. So with those 2 things, you can achieve anything you want.
Wow.
And you can probably match a lot of the professional portfolios that are out there, if not beat them. And that's the shocking thing. Very simple. And then the overall cost for that, for the platform, you should never pay more than 0.15% of your total wealth per year. For the funds you buy, again, very unusual to pay more than 0.2%. So all in, we're talking about 0.3.
In terms of your overall fees, that you're
exactly.
paying,
So that's how much you're feeding to the vermin, the financial crows. But you want to pay as little as possible because what benefit does it give you? None really.
Exactly. There is no benefit for paying more fees.
And then once you've started the saving process, try and automate it because if you've got direct debit, it's just psychologically there's less friction. And the money will automatically go in, it'll be invested. On many platforms, they have automated investing where you tell them the portfolio and it's actually free to trade because they know the trades are going to happen on a schedule. It's just cheaper for their back end, for their back office to do that. So, anything which makes it easier to save psychologically is a good thing.
Love that. And is there any pitfalls, right, for new investors to kind of look out for, especially if we're talking about them, starting their first investment?
I think don't give up. I think that's the main thing. Because when you have a small amount invested early on, you just can't see the compounding because it's slow. If it's going to drift up at 6% a year with a huge fluctuation laid on top, short term, all you see is the volatility, the daily fluctuations. Long term, if you zoom out, and that's why I think it's useful to look at the history of the stock market because you'll see the trend, which is the upward trend. And the volatility kind of becomes less important. But our lives, our consciousness, lives minute to minute. So we see volatility. That's what's difficult. You've got to have faith that it's going to go up. And that's hard. Early on it's very difficult. But in 10 years' time, you will be so glad.
Yeah.
And I often tell people, look, imagine you had a telephone and you could speak to yourself 30 years in the future. What would that person be telling you? They'd be telling you, put as much as you can into the stock market. Because, yeah, bad stuff happens, but in the long run, it all kind of worked out.
Yeah.
The optimism, it was a triumph of the optimists.
Yeah. And that's the thing, right? I think it's like you say, taking money from the impatient to the patient. It's honestly, I love that saying. It's so important. So investing in low cost global index funds, right? We mentioned that, right? ETFs and global index funds. Actually, before we go there, what's the difference between an index fund and an ETF? Because people do get confused with that, and you can invest in both. So
yeah, you can buy a fund in various wrappers, and the wrappers would be things like an OEIC, an open-ended investment company. Now, those things only trade, you only get a price of that at the end of each day.
Yeah.
You buy it directly from the fund manager via your broker, so you don't really see the difference, but that's how it works. So that's an OEIC. In America, they call it a mutual fund. Another wrapper is an ETF, so an exchange-traded fund. Now, those get priced intraday. So you trade them on the London Stock Exchange. The price changes minute to minute. It's very liquid. You can sell it immediately. And this is why Jack Bogle didn't like ETFs. He said, well, I've been telling everyone they should just buy and hold. Why would I give them something where they can sell it in a minute?
Yeah.
The liquidity is incredible. But if you look at the return, so let's say we've got two funds, FTSE 100 tracker, which is an OEIC, FTSE 100 tracker, which is an ETF, the returns will be almost identical, assuming the fees are the same.
Yeah.
So it's what's in it that matters, not how it's wrapped.
Right. Okay.
But on some platforms, you pay a lot more to hold it in the form of a fund than you would as an ETF.
Right.
So on Hargreaves, for example, at the moment, you pay a lot in order to hold the fund version of that FTSE 100 tracker.
Wow.
Whereas for the ETF, you pay a fixed fee of like 45 quid, I think 40 or 45 quid a year for all of your ETFs. Whereas for the fund version, you pay a percentage. I think it's 0.4%.
Oh.
So that can scale up if you've got a large amount. So it's really very different if it's an ETF or an OEIC on that platform. On Vanguard, no difference. The fees are same. It's 0.15%, capped at 375 a year. So really depends on which platform you're on, which is the better choice.
Okay.
But some platforms are ETF only. You can only buy ETFs. But so often people say to me, would you buy an ETF or an OEIC? I don't care. Whichever one has a lower fee, the returns are based on what's in it, not on the wrapper. If I was on a platform where it was expensive to hold OEICs, then I wouldn't hold them. I'd go for the ETFs.
Yeah. See, this is the thing about investing, and I think this is where it gets confusing for people, because I agree with you. Like, even with like some global, and this is from a pension. I was actually talking to somebody about it as well. So when I was trying to change my pension to invest in few like global funds, there was like loads of different ones, so many options. There was one, I narrowed it down to two options, and I think they were all investing in the global companies, but I think like their percent that they were investing in America was slightly different, like maybe by a couple percent. I was like, why would you offer these two? What's the point? So it can be, I feel like there's sometimes there's too many options available out there. So how can people kind of understand or figure out like what's the best option for themselves, especially like where we're talking about, it's great to invest in global index funds and, global ETFs?
I think the important thing is if it's a global fund, there's only one world. And that's why they all offer very similar returns. So, maybe there are 10, 20 different global equity funds available to UK investors. People really sweat about which one to choose. They're all the same. It all tastes like chicken. If you look at the top 10 holdings of any of these funds, what is it going to be? It's going to be Apple, Microsoft, Nvidia, Tesla. It's going to be the Magnificent Seven that dominate. And, even if you go down to the 500th entry, it's going to be very similar. So I wouldn't sweat it. Just go for one which is low fee. And now you can get index funds which are global for about 0.12%.
Yeah.
And the fees are going down all the time because there's competition. So it's a great time to be an investor right now because it's so cheap.
Yeah.
As long as you know the secrets, which aren't really secret, how simple you can make your portfolio and just have something which is very effective. So all I'd say is, don't sweat it when it comes to the global equity fund.
Yeah.
Any index will do, whether it's FTSE's All World Index or MSCI's All Country World Index, ACWI, some people call it. Those are the same thing, really. They'd be very similar returns. So just go for a cheap one.
Yeah. Do you think that this strategy, right, of investing in a low-cost global ETF or index fund, that's been a proven strategy for people to build wealth? Not a lot of headache. They're very diversified because they're investing in global companies across the world. They've got low fees. Do you think that will still be this go-to strategy for building wealth in the near future as well, near and long-term future?
Well, I think what's special about it is that it's so effective and so many people are now doing it. And the other point, I guess, is if you buy a fund which is managed by a person, that person could retire, they could fall under a bus, they could move to another fund. So, that doesn't have longevity. Whereas a global index, that's always going to be there, or it's going to be there for generations to come. It'll change. The composition changes a lot. And I often like to show clients a portfolio from 1900. So right now, the US dominates, right? So it's like 65% of global market is US equity. The UK, 4%. Go back to 1900 and we were the big boys, right? So, we were like 20% of markets was UK, whereas the US was a kind of backwater. It was, maybe 10, 15% of global markets. But then after the First World War, that's when the US became really dominant. And the really hot tech stocks in 1900, railways. So half of the stocks in the stock market then, railway stocks. That's all people wanted to buy. So you can see how the indexes would have changed over time, just naturally. And the same is true in the future. Now it's dominated by tech companies in the US. Who knows what it's going to be when my kids own index funds? Maybe some country we'd never even considered is going to become really dominant.
That's a good point. Yeah. So do you think people should as well, change? I think you kind of alluded to it before, change the way they invest, or is that global investing in global, index funds or ETF, right? Does that work no matter what age you're at?
The horizon's what matters.
Okay.
So if you've got a short time to live, so I've got lots of grey hair. You've got very little grey hair. If you screw up now, you're just going to brush it off, right? If I screw up now, I've got a lot less time to recover. So you can take risk, which I can't. And you can see volatility and just laugh at it. I see volatility and it scares me, right? So I think really your investment horizon is driven by your lifetime and how much life you've got left.
Yeah.
So that's going to affect us.
Yeah.
So no, I don't think it's the same for everybody.
Yeah. So it should be changing, but it should be on your time horizon. And like you say, if your time horizon starts going to the 5 years, like us connecting the dots based on what you're saying, if it goes to less than 5 years, then the market's on a high, then you think of selling, you think of putting your money in government bonds, like secure ones, and market money funds. That's how you should be thinking. right?
Yeah, that's right. That's right. And, early on, you should try and put as much as you can into the equity market because you don't care about the volatility.
Yeah.
In retirement, you're living off that pot. You better preserve it as long as you live because you don't want to be dependent on your kids or, living off a state pension, which would be really quite painful. So I think that's the important thing. You've got to gauge your risk based on your needs and your time horizon for when you need the money.
Yeah. So my question is, why is it so tough? Because we do know these stats that even professional investors, like you say, cannot beat the market. The only one that we really know is there are more. There's obviously Warren Buffett is one of the most famous people, right? I think there's somebody called Howard Marks, although I don't know Howard Marks is his return, right? But anyway, the premise is that most professional investors can't beat the market. So therefore, your average investor can't. Why is it so difficult for even professional investors to, beat like the S&P 500 or, global index funds and ETFs?
It's a really good question, and it's really hard to answer. Nobody really knows why markets are so effective and index funds are so effective. And people didn't realize they were effective until they started measuring returns. And there's a fascinating book by Robin Wigglesworth. Now, he's a journalist from the FT, and he wrote a book called Trillions, which talks about the creation of index funds. And it was until the 1960s when people actually started having this idea, why don't we just buy the whole market? Why mess around with single stocks? Just buy everything. And it was impossible at that point to do it because they didn't have computers.
Yeah.
So the question then is, how much of each stock do you buy? And they came up with the idea of market cap weighting, where you buy more if it's a bigger company. So Apple makes up, 3% of the global market now. Microsoft a little bit less, and so on down the list. Turns out that portfolio is incredibly effective and it's very cheap to create because if the stock prices go up or down, then your index automatically tracks it. You don't have to buy or sell anything. So it's very cheap to create a fund, which is market cap weighted. But the question about why it's hard to beat, the answer is kind of surprising, right? Which is that markets are efficient, which sounds pretty weird, but all it means is any information that comes along is almost immediately priced into the stock. That means that you don't have an informational advantage. If you do have an informational advantage, you'll go to prison because they call that inside information.
Yeah.
Now, when we were working as strategists, we were trained night and day about what material information about the value of a stock is and how you should never, ever publish it without giving the entire market that information. So if you have market moving information, so let's say you've got a friend who works for a company and they tell you, don't tell anyone, but we're about to have a takeover offer from this company and our stock price is going to go crazy. Now, if you know that, it's almost like you have to go into a state of purdah, they call it, where you can't tell anyone about that. So if your friend had told you that and you work for an investment bank, you would not like that person because you couldn't tell anyone. Because when you have this material information, you have to tell everyone at the same time.
Yeah.
So you don't have an informational advantage.
Yeah.
So you can't beat the market because you don't know anything that anyone else doesn't.
Okay. But yeah, why do people still, despite knowing this, despite knowing the odds are against us, the information is against us, some people listen to this, even me sometimes, right? Why do we still invest in individual companies?
I think it's about narrative.
Yeah.
People like stories. They don't want to know about some theory about market efficiency. They think, well, I buy the products, I like the company, it's well managed, it's been around for a long time, it's generating a lot of profit. Yeah, of course it's going to do well. But the fact is that everybody knows that, same as you. So you don't really have an edge that other people wouldn't. But we feel we do. And there's a narrative, there's a CEO, we know about the products, we know about how they've changed our life. You get people, for example, on Tesla. If I ever say anything about Tesla on my YouTube channel, you get the Tesla fanboys who just shoot you down. or, crypto. People, if you say anything negative about crypto, you get this deluge of abuse because it's almost like a religion.
Yeah.
People are convinced this is going to work, that it's a good thing. And I always think that if you find yourself in that state, it's a problem, right? Because you should never be wedded to something psychologically.
Yeah,
but
that's true.
But beating the market, so hard.
Yeah.
And you're so poorly resourced compared to these professional fund managers. They've got an entire research team behind them often. They've got a Bloomberg terminal. They can do this night and day. That's all they do, trying to choose the best stocks. And they fail 80% of the time, which is just shocking. I mean, just think about any other profession. Like if you were a taxi driver and you said, look, could you take me from Whitechapel to Marylebone? And they said, yeah, Gov, come on, get in. But there's only a 20% chance we're going to get there. In fact, I might drive in the other direction. Would you get in the cab?
No.
Or any other profession, like a doctor, I've got this rash. Can you get rid of it? Well, there's a 20% chance that I'm going to be able to get rid of it.
Oh, gosh.
It wouldn't work in any other career.
Yeah.
So, I didn't even know that stat. When I worked in banking, it was never discussed. You just assume people can beat the market. Maybe they were unlucky sometimes, but, our research and their skill, surely they can beat the market. But no. When you look at the stats, what's even worse is the longer the period you track someone, the larger the probability that they'll underperform, which suggests that the ones which actually do beat the market are just lucky. If it was skill, they'd consistently outperform.
Yeah.
And that's not what we see.
Wow. That is so incredible. And it just really hits home of why you just need to keep it simple, something that's well diversified. And actually, I wanted to ask you about the benefits of, your approach where you say you only invest in one fund, right? One global fund, right? How beneficial has that been for you to just do that? Keep it simple, and then your money's just going into this one. Is it index fund or ETF?
I think mine's a fund.
Okay.
Mine's now an ETF. I had a fund for a while.
Into ETF. Yeah. So this global ETF, how beneficial has that been for you to know that you're just investing in this monthly, automated,
It's been great. I just wish I'd done it sooner because it's so simple. I can't fiddle with it. It's kind of like, do you still watch the Teletubbies?
No. Me.
Did you ever watch the Teletubbies?
Yeah, when I was younger, probably.
Okay.
Yeah.
Well, so you remember the Tubby custard machine?
No, I don't remember.
Well, it had one big red button that produced custard.
Okay.
Right? So my portfolio is like that Teletubby custard machine. It's just got one big red button. I can put more money in. I can take money out. That's all I can do. It's so simple. I can't fiddle with it even if I wanted to. Whereas if I was doing like a regional allocation, some US, some Europe, some Japan, and, I can fiddle with it, that's what I'd do.
Yeah.
And I'd worry about whether I had the right allocation and maybe I was underperforming. Now I just know exactly what it's worth because I can just look it up, one fund. And it's just very easy.
Yeah.
I just wish I'd done it sooner. But don't copy what I do because for me, I don't need the money anymore. I probably won't need the pension either because I've got Pensioncraft, which is generating an income for me. So that's why I always say to people, don't copy what I do because my circumstances are not the same as yours. So if I was not having an income from Pensioncraft, I'd probably have more safe stuff in the portfolio.
Okay.
Maybe I'd go for 80% equity, 20% bonds, maybe some commodities in there as well. Try and diversify it, mix it up a little bit. And that way you can live off the portfolio if you need to.
Yeah.
But I think for me, it works well having one fund.
Yeah.
Plus, I know people do look at what I do. So I'm really careful to do the right thing.
Yeah. And that's the thing, right? It's about, I think, like you say, you said some amazing insights in terms of figuring out what your goal is, your time horizon, and that really dictates what you provided options in different times, right? So if it's less than 5 years, like we said, things like UK bonds. Is US bonds good too?
Well, the trouble with US bonds is you've got the currency risk.
Okay.
So, sterling versus the dollar is all over the place.
Okay. Oh, yeah, because our currency versus theirs. Yeah, okay.
Whereas our gilts, the UK gilts, no currency fluctuation. And it's a UK thing. So I always feel a bit
fair
more
enough.
Comfortable with that.
Yeah, okay. That makes sense. But that option, of UK gilts, money market funds, less than 5 years, right? Or actually savings account. Right.
Money market funds and savings accounts, usually pretty similar returns.
Yeah. So, and if it's more than that, then you kind of know. So it's really all dependent on your time horizon, right? And I think that's important. So I wanted to, ask you a few more questions about this. So in terms of the risk though of investing, right? What are our major risks as investors when we invest in the stock market?
Biggest risk is you.
Yeah.
Because if you sell when markets fall, you'll crystallize a loss. And that's the worst thing you can do. The other risk is you don't invest enough, right? Because people assume that the market's going to do all the heavy lifting. No, it won't. The market will not make you rich unless you invest. So the heavy lifting is you doing the graft, earning the money, scrimping and saving, and putting the money into risky assets. So that's hard. And you've got to do it over a long period of time. So I think that's why people don't usually succeed at it, because they just don't stick with it.
Yeah. That's the thing, right? They just don't stick enough and they don't do enough. They don't stick enough because they're scared of the one loss or however, and they don't, continue to understand, invest in the stock market in a better way. So I've got this question, right? So I know you've got your combined experience of, being on the other side of, working at an investment bank. And now you're on this other side where you're now continue post that, doing your own investment and learning in that way as well. With that combined kind of experience, what are the key lessons you kind of learned with the combined experience of, being in investment banking and then doing your own investing as well?
I think the main thing is knowing the incentives. Is the person you're speaking to making money by gathering your assets? So, for example, a wealth manager, they're just trying to get your money on board and they just take a percentage. Is the person you're speaking to on a commission? Do they get paid a commission to put you into this product or that product? Because if they are, then they're not really acting in your best interests. So I think understanding the incentives of your counterparty are really important. Your broker, they're trying to get you to trade a lot. Your wealth manager, they're trying to get a lot of your money on their platform because they take a percentage. So understand those incentives because often they're not in your best interests. I think that was the big learning, I think. Understanding what people's motivations are, what institutional incentives there are.
Amazing.
And how that can really screw you up.
Yeah. Thank you. And it's important, I think, to hammer that home because, like you said, you had somebody who's paying 10,000 in fees almost, and versus they could be paying 100, and I think that's very important. So we got to talk about crypto because you mentioned it a bit, and everybody's talking about it now. What are your thoughts on crypto that you're invested in yourself? Why did you invest in crypto, and where do you kind of see it going?
I kind of like it.
Okay, that's good.
For me, it's kind of like almost blasphemy, having something which is obviously a Ponzi scheme, right? In the sense that, does it have any value? Not really. Does it do anything useful? No, not really.
People would argue that it does, though, right?
I've heard all the arguments. I've heard all the arguments that money is basically worthless and it's going to be a waste of time. But really,
now that you say that, right? We're going to talk about it, and we probably will get comments about, it does have utility, it does have value, but are people currently using it for that utility and value?
Yeah, I mean, what can you do with crypto that you can't do with cash? And if it is, I think primarily it's about speculation, right? So people want to make a quick buck. And that's why it's almost blasphemy for me to play around with it, because that's not really my psychology.
Yeah.
But, what is the value? I think you learn a lot about markets. So some of these crypto platforms, they have a kind of pro level where you can see the entire market. You can see the bid offer spread. You can see the entire trading book. So if you want to learn the inside out version of what's going on in markets, it's brilliant. And it trades 24 hours a day, 7 days a week. In lots of ways, it's very technologically innovative. But does it provide any real value? I don't think so.
Yeah.
And really what it comes down to is when you buy a security, it generates something useful to society and it provides a sequence of cash flows in the future, which you have a claim on. So if you buy a bond, you get the coupons and you get your money back at the end. If you buy a stock, it pays dividends because Apple makes products which people love and they give you some of the money back in the form of a dividend. If you buy crypto, it gives you nothing, right? Its value is what...
a lot of people, by the way.
Oh, yeah. But its value is what people are willing to pay for it. Gold is kind of similar because gold doesn't pay you cash flows. It's just because it's shiny, it's durable, and it's restricted in supply. But I think what people get wrong is just because something is scarce, it doesn't necessarily have value. If people move on to something else, well, its value goes to zero. It's kind of like Tinkerbell. Do you believe in fairies? If you go to a panto and all the children are screaming, yes, I believe in fairies, and they have to clap their hands. It's kind of like that. While people are clapping, it's going to have value. But once the clapping stops, that's a problem.
That'll be very interesting, and we're gonna get people saying, "Oh, Atto and Ramin don't understand crypto." I see it all the time. But we're both invested, so there is an interest there because I'm interested to see what happens with it. It's very interesting because you never know; it might morph into something else. I don't know. Thank you so much, Ramin. It's been a great conversation, and we've talked through a lot and you've shared a lot, so I really appreciate it. So can you talk a bit about Pensioncraft and what motivated you to create it and where people can kind of reach out to you via it as well?
Well, we've got the YouTube channel. That's how people know about us. And so we've got a community. We now have about 1,000 people in our community. And if you want to become a member, just go to pensioncraft.com/membership. You can find out more there. But essentially, it's a place where people can talk about investment in a kind of safe way. And they often tell me that they can't discuss it with their family. They can't discuss it with their partner because they're the kind of finance nerd in the family. And nobody else understands it. And they watch some of your videos and they think, oh, okay, this kind of makes sense. And then eventually they join our community. Because, I say in the videos, join our community. And I'm not trying to sell them anything, which they love because they trust us for that reason. All I'm trying to sell them is the knowledge about how to manage their money. So let's say they want to buy a gilt. It's scary. The first time you do it, you think, what the hell does this mean? What's a clean price? What's a dirty price? But they can ask questions about it on our chat channel. So I think that's useful, having that safe store of information and a wide variety of people from all over the world. We've got some people who aren't in the UK, some people in Singapore, Saudi, all over, all sharing their life experiences. And now they answer questions faster than I do, and that really pisses me off, and better than I do. So, before I've started typing, someone chips in and they've got a really good answer.
That's what you want. That's a great
community. But it's great, and people like that, and they stick with us. That's what's even more surprising, that, we thought there'd be a lot of churn, people would join and leave. But I suppose we haven't raised our prices for a long time. Maybe that's why. But, I think that's why people like it. And it is like a family. We really value the fact people help each other. Every so often we have a competition we get people to vote for whoever's most helpful, and they get lifetime free membership of the community. So we're trying to promote this idea of being helpful. But people do it anyway. Sometimes, they get a prize and they give it to some kind of animal charity because they know I like dogs. But we're trying to kind of promote that. But that's how you can find out more.
Amazing. Thank you so much, Ramin. Like I said, it was great having this conversation with you. And I'm not surprised why so many people are part of your community, because it's a great information. I think what I really appreciate is investing, especially in the UK, needs to be demystified. I think we need to talk more about it, like how they talk about it in the States. In the States, they're really comfortable talking about it, but here in the UK, we're not as comfortable. So I think it's very important, especially as it's a very accessible way to build our wealth. Like we were saying, so amazed at how we can do that. You know, you can start investing from as little as £1. And appreciate you sharing all the insights that you had. It was really amazing to hear the other side of, you know, how money works and, you know, how they will kind of take away from you. But there's a path for you to kind of get around that. Do you have any final words for watchers and listeners?
Yeah, I'd say just keep it simple. You know, just start off really simple, be disciplined, and do it for the long term.
Yeah. Amazing. Thank you so much, Ramin. Really appreciate you featuring on the podcast. Thanks so much for tuning into this episode of the podcast, and see you next week's episode.